let's take a minute here to look at the effects of interest rates and what's going to happen with equities. Something that I don't think, man, if you're probably under 35, maybe 40 years old, you never lived through an interest rate that really mattered, um, where it made it more attractive to put your money in the bank, whether it's a savings account, a money market account, or locking stuff up in a CD, for example. I remember um, how I opened my first bank account when I was like 12 or something. Had to stash all my money so my family wouldn't steal from me. um, I go back in the mid 90s, early mid 90s, late 90s were 5%, 6%. So, for every $100,000 if you had back then, you get 5,000. I mean, that's not bad. Decent, safe returns, right? If you had that kind of money, if you had $1 million in an account, pretty good returns for doing nothing. And then they went down. They went down. Had this little roll up here in 2006 where we had that like mortgage boom going on. Rates started to creep up again, 4%. Then we had to crash, and then look, man, since 2008, it's just been no 0.17%. Crazy. Well, why would you put your money in the savings account right now at 0.34, and inflation's much higher than that? You're just losing. You're definitely losing right now with inflation if your money's just sitting in a savings account somewhere. Hell, it's losing if you're in equities right now because they're getting hammered. But what I want to talk about is when rates start getting around 5 or 6%, people, instead of that like traditional bond slash equity, blah, like they got all these different formulas people run. They got, 60-40, 80-20. They got these different mixtures of where you put your money. Some people put their money in real estate. Some are going to buy equities. Some invest in businesses. We've not talked about that since hasn't even, maybe 2006 a little bit, that area, because rates were going up. But you pretty much got to go back to like 2000 and before. Even then, it was only around 5, 7%, 5, 6%. It's one of those things that, all right, now I'm going to put 10 or 20% of my portfolio into CDs because it's just the safest thing out there at the end of the day. It's, and I'm not giving financial advice in any way. It's not what I do. But I mean, the idea of putting money locked in rate on a CD sounds better than putting it into some tech equity that could just bomb. So what happens when the money stops pouring in to the stock market? Because if rates get crazy like in the 70s and 80s, what if savings accounts are paying 7, 8, 9%? Well, you might just go lock your money up for 5 years and say, you know what? I can at least keep up with the pace of inflation. I'm going to lock this money in. It's pretty safe because I don't know where equities are going. Housing market's a mess. Mortgages are a mess. Excuse me. I'm just going to lock it up, and then that's going to that will hinder the recovery of the stock market because people are going to start, especially if you're anywhere near retirement, you don't want to take any risk. We're going to start pouring that money into CDs. We've never had that option in the last, decade, maybe even two. Unless that one period of time around 2004, 2005. But even then, put it in the stock market, right? For 4 or 5%, I might as well try. I'm gonna go buy some S&P 500. Go buy a growth fund or something, right? So I'm just curious if we keep raising rates to try to battle the inflation right now. That alone can put a hurt on equities. It's gonna put a hurt on mortgages and car loans because things are gonna get your buying power goes down as interest rates go up. The difference between a 3% mortgage and a 6% mortgage, I think you lose 50% of your buying power. It's crazy how much, it's not crazy, but it's crazy to the average person. You see how much house you cannot buy when interest rates double. So you're going to see a slowdown in durable goods, car sales, any of that big financing stuff, and then credit cards are going to get hammered too, right? So when you have all that stuff going on, it's going to bring the stock market down more than likely. And then when you have money flowing into CDs instead of going into equities, it's going to take longer for the stock market to recover. So what happens? If we go to a 5 or 7 year period of inflation where the rates got to stay high and we're pouring money into CDs instead of the stock market, you saw a lot of these old time, it might have been Charlie Munger, if I'm probably messing his name up. Maybe even Buffett, some of these guys that are talking about there's going to be a decade of lost returns potentially. Um, and, they talk about 2000 to 2010, the average, anyways. There's always going to be some hot stock to maybe invest in, right? But when you start factoring in, well, what if you go through a 10-year period where rates are up and everyone's piling their money into CDs and then the stock market's not booming? You're not going to see this stuff where stocks were going up, 30% in a 6-month period. Like last year was crazy what was going on, and this year's been a bloodbath. Is anyone thinking about this stuff? Like right now, I'm thinking I got companies I'm going to sell. There's some I'm going to start. There's some I'm going to offload. There's some I'm going to reinvest in, and try to grow. But then it's like, excuse me, allergies. Right now, it makes the most sense to just keep building my companies and maybe starting new companies because their return on investment is going to be greater than what a CD is going to give me. And if the market stays this way with the equities, going to be far greater than what I'm going to get in equities. And then the housing market, as far as looking at even commercial real estate, I'm not excited. Residential, it's so overpriced. I'm not excited for that. Money best spent right now is growing the current businesses I have or investing in new businesses that have some kind of longevity in the next 10 to 15 years. Do I want to lock my money up at 5% in a CD? Doesn't sound exciting. Do I want to put the money in the stock market and hope I get 10%, 12%? I mean, that's if things turn around. Or the downside risk to that is substantial. Man, there's not, and then get into the real estate market where I watched some things go up 50, 70% in the last 12 months. I don't want to buy a spec house property at $1 million and then the market crashes and sell it for 600. Like that says way too much risk for how much upside. How much upside is left in that market? Not worth it to me. So keep investing in current businesses, grow them as large as I can, and invest in and start new companies. They're going to have a greater return on investment than anything that I'm seeing residential, U.S. equities, or even CDs if interest rates get high enough right now. Do something that produces a good or delivers a service that people need or businesses need, and try to generate a decent return off of that, while you're also growing the business as an asset, which you can sell at a later date. Again, I don't know where we're going from here. They're hoping for this quote-unquote soft landing. Maybe they don't have to get too aggressive with rates. We're going to find out. I wouldn't be surprised if you got a couple 75 basis point shocks coming. The stock market's getting hammered. I think it's finally starting to send the message. Not seeing it in the real estate market, though. It's still up there. And I think they're going to keep going until that bubble pops. And then maybe we'll see. But until then, who knows? I just keep in mind that when those rates start getting around 6%, less money is going to go in the stock market and money is going to go into CDs, which we're not going to have these crazy pops in stocks anymore until money starts flowing out of those CDs and back into the market. We're not there yet. We got a little ways to go, but this is what could be coming. So anyways, if you have any thoughts, drop a comment below.